The dollar can look safe. The yen can look weak. The euro can look broken. And all three can be the wrong map. Because market signals do not protect you when you treat them like directions. They only show where the system is under stress. A signal is not a map. It is a bruise. Most people enter the market looking for clarity. They collect charts, positioning reports, rate statements, inflation prints, headlines, and expert language. Each signal feels like a small piece of control. Each one seems to reduce the fear of being wrong. But this is where the false safety begins. The market does not become safer because you have more signals. Sometimes more signals only give the mind more objects to trust. And once a signal becomes protection, you stop asking what it measures. You start asking it to save you. That is the moment the map begins to fail. Begin with a full beat of silence, so the opening line lands before the viewer starts defending the old map. The old belief was simple. If you collect enough signals, the market becomes readable. If the dollar is strong, something must be safe. If the yen is weak, something must be obvious. If Europe looks stressed, something must be broken. If positioning is crowded, someone must know something. This belief is comforting because it turns uncertainty into a puzzle. And puzzles imply that the answer already exists. You only have to find the missing piece. So people read more. They compare more. They follow more calendars, more reports, more central bank sentences, more market notes, more charts. And for a while it feels intelligent. But intelligence is not the same as protection. A market signal can be useful and still incomplete. It can be accurate and still late. It can describe pressure without telling you where pressure will break. The old belief says more data creates more clarity. The new reality is colder. More data often reveals more ways the system can fracture. That is the first seduction. Not prediction, but the relief of believing confusion can be organized. False safety begins when evidence becomes shelter. A signal is supposed to inform you. It is supposed to show that something has changed, or that pressure is building somewhere inside the system. But the human mind wants more than information. It wants a place to hide. So a chart becomes a shield. A positioning report becomes confidence. A central bank statement becomes permission. A headline becomes a story that makes the next move feel inevitable. This is why market reading can quietly become emotional dependency. You are not only reading the signal anymore. You are asking it to remove the burden of uncertainty. But markets do not remove uncertainty. They redistribute it. The same signal that looks protective from one angle can become dangerous from another. A crowded position can look like confirmation. A policy statement can look like stability. An inflation print can look like direction. Until the conditions around it change. And then the thing that felt like evidence becomes the thing that trapped you. That is the trap. Take positioning. The Commitment of Traders report can show how different groups are positioned in futures markets. That matters. It can reveal crowding, imbalance, pressure, and the emotional shape of a market. But positioning is not timing. A report can show where pressure was visible. It cannot promise when that pressure will matter. It cannot tell you when a crowded trade will break, when a reversal will start, or when a policy shock will interrupt the structure. That distinction sounds small. It is not. Because the mind wants to turn positioning into a clock. It sees a crowded market and says now. It sees a one-sided trade and says soon. It sees professional positioning and says they must know. But a position is not a prophecy. It is a footprint. And footprints tell you where someone has been. They do not guarantee where the ground will collapse next. The signal may be real. The certainty attached to it is the illusion. This is why a late signal can still feel powerful. It gives language to pressure already moving. A crowded trade rarely feels dangerous at the beginning. It feels safe. It feels rational because many people can explain it. It feels confirmed because the same argument appears everywhere. It feels professional because the language becomes technical enough to sound protected. This is the quiet psychology of crowding. The crowd does not arrive wearing a warning label. It arrives as consensus. It arrives as confidence. It arrives as a sentence that everyone has already learned to repeat. Strong dollar. Weak yen. Broken euro. Higher for longer. Policy divergence. Risk premium. Safe haven. soft landing, hard landing. Each phrase can contain truth. But when a phrase becomes too easy to repeat, it can stop being analysis and become shelter. That is when the crowd becomes most dangerous. Not because everyone is stupid. Because everyone is using the same signal to feel less exposed. And when the same signal protects too many minds, it can become the risk itself. And the more respectable the consensus sounds, the harder it becomes to admit that consensus is still exposure. Then policy enters. This is where the map breaks. A currency can look weak. A flow can look obvious. A trend can look clean. Positioning can look one-sided. The story can feel settled. And then a policy authority changes the pressure. It does not have to explain itself in the language of your chart. It does not have to respect the comfort of your positioning. It does not have to move according to the story traders were repeating the day before. This is why policy risk is so brutal. It reminds the market that flow is not sovereignty. A central bank, a finance ministry, a trade authority, or a government decision can interrupt what looked like a clean signal. Not because the signal was fake. Because the signal was never the whole system. The mistake is not noticing weakness. The mistake is believing weakness gives you ownership of the next move. Policy can override flow. And when it does, the map becomes evidence of yesterday. That possibility changes every signal. Inflation data creates the same trap. People want a number to become a road. A higher print should mean one direction. A lower print should mean another. A central bank sentence should tell the market what happens next. But policy does not operate inside one number. It operates inside tolerance. The Federal Reserve can hold rates and still say it is watching incoming data, the evolving outlook, and the balance of risks. Inflation can remain above target while growth, employment, energy, and financial conditions all pull on the decision at the same time. This is not a clean road. It is a pressure field. The same inflation print can mean persistence, caution, delay, or constraint depending on what the system can absorb next. So the number matters. But the number is not the map. It is a stress reading. And stress readings do not tell you where to go. They tell you where the system is becoming less flexible. That is useful. But it is not safety. Context decides what the number becomes. Europe shows the same problem from another angle. A currency zone can face inflation risk and growth risk at the same time. Prices can pressure policymakers upward while weak momentum pressures them downward. Energy, trade, political risk, and global demand can all pull against the same central bank sentence. This is why a signal can be correct and still fail to protect you. A rate statement can be accurate. A growth warning can be accurate. An inflation concern can be accurate. A tariff headline can be real. An oil shock can be real. But none of them alone is the map. The market no longer follows one axis. It does not move only on rates. It does not move only on inflation. It does not move only on positioning. It does not move only on trade. It does not move only on energy. It moves through collision. And when systems collide, clean signals become unstable guides. They still tell you something. They just stop telling you enough. The signal may be true locally, while the system around it is changing globally. This is why reading more can make you feel less safe. Not because you know less. Because every new signal reveals another condition that can break the last one. You read positioning, then policy risk appears. You read inflation, then growth risk appears. You read central banks, then energy shock appears. You read trade policy, then liquidity shifts. You read one currency, then the entire global balance of stress changes around it. The beginner thinks confusion means ignorance. But sometimes confusion means you are finally seeing the system without the fake simplicity. The danger is that the mind hates this state. It wants to compress the complexity back into one sentence. The dollar is safe. The yen is weak. The euro is broken. The Fed is hawkish. The ECB is trapped. These sentences feel useful because they reduce anxiety. But the market is not required to stay simple just because simplicity feels calm. More reading does not always create protection. Sometimes it removes the illusion that protection existed. This is the exposure. The mind still wants one answer. That is the trap. It wants one signal to dominate. One chart to confirm. one institution to explain, one expert sentence to settle the conflict, one macro story to organize every price. But the market is no longer offering answers in that form. It is exposing stress. A strong dollar may not mean safety. It may mean demand for liquidity, fear, relative policy constraint, or lack of better alternatives. A weak currency may not mean collapse. It may mean policy tolerance, intervention risk, structural pressure, or delayed repricing. The signal is never alone. It sits inside a network of other signals, each one changing the meaning of the last. This is why the search for one answer becomes dangerous. Because once you choose one signal as the map, you begin ignoring the forces that can invalidate it. The signal still speaks, but it speaks in fragments. And fragments should not be mistaken for shelter. The more the mind demands one answer, the more it filters out the conditions that make the answer fragile. The realization is simple. A market signal is not a direction. It is evidence that pressure has appeared somewhere in the system. That changes how you see everything. COT becomes a record of positioning pressure, not a timing device. Inflation becomes a stress reading, not a guaranteed path. Central bank language becomes a map of tolerance, not a promise. Policy risk becomes a reminder that authority can interrupt flow. Crowding becomes a psychological condition, not confirmation. Nothing here says signals are useless. The opposite is true. Signals matter more when you stop asking them to do the wrong job. They are not there to make the future safe. They are there to show where the present is unstable. This is the deeper shift. You stop asking, what is the signal telling me to do? And you start asking, what kind of stress had to exist for this signal to appear? That question is colder. But it is more honest. It replaces the comfort of prediction with a quieter discipline, reading pressure without worshipping it. Once you see signals this way, the market becomes less comforting, but more honest. You no longer need every chart to become a prediction. You no longer need every report to become protection. You no longer need every central bank sentence to become a direction. You begin to see the market as a living field of constraints. Positioning shows where people are leaning. Policy shows where authority may resist. Inflation shows where tolerance is narrowing. Energy and trade show where external pressure enters the system. Crowding shows where fear has disguised itself as consensus. This does not make the future predictable. It makes false safety easier to detect. And that may be the only real protection a signal can offer. Not certainty. Not timing. Not a clean map. Just a warning that somewhere pressure is building. So the next time the dollar looks safe, the yen looks weak, or the euro looks broken, pause. The signal may be real, but the map may already be wrong. That is the silent alpha move, refusing to turn any signal into a false shelter.